Welcome to the deep dive. We're digging into the June data that's really shaping Canada's economy, and especially the Toronto real estate scene. Remember last month? We talked about that market holding pattern, a real standoff.
Yeah, buyers and sellers just weren't budging.
Well, now the picture, it's sharper and, frankly, a lot more complex. We're seeing, new buyer moves, some worrying signs in construction, and a summer market that's, well, not typical. So today, we'll break down what's changed, what it means for you, and some critical new things to watch. Okay, let's dive in. National indicators look strong on the surface, but it feels a bit deceptive, doesn't it?
It really does.
Bank of Canada held rates at 2.75% in June. No big surprise there. But headline inflation's 1.7%, while core inflation still stuck up at 3.0%. That's a tough spot for the bank.
And what's fascinating, digging into that apparent strength, Q1 GDP up 2.2% looks okay.
Right.
But peel that back, it was mostly exports and companies stockpiling inventory, likely because of tariffs.
Okay, not real domestic activity then.
Exactly. In fact, final domestic demand, that's the real measure of health at home. It actually fell. First time since Q3 2023. Consumers, businesses, they're pulling back.
Wow, fell for the first time in, almost 2 years?
Yeah.
So if the bank's in a tight spot and GDP isn't quite what it seems, where else are we seeing stress for households? Any specific red flags?
Oh, absolutely. The Q1 2025 Equifax report really stood out. Mortgage delinquencies are still low, which is good.
Okay.
But non-mortgage delinquencies, credit cards, car loans, that stuff they've surged. Highest levels since 2010.
Since 2010, that's significant.
It's a critical leading indicator, shows financial stress is definitely building up under the surface. And speaking of stress, that volatility in bond yields.
Yeah, the 5-year Government of Canada bond.
Exactly. Explains why fixed mortgage rates haven't dropped like people hoped. Tariff uncertainty really shakes confidence in those longer-term bonds.
Got it. Okay, complex backdrop indeed. So how does this all translate to the Toronto real estate market? What's the June TREB report telling us?
Well, it painted a picture of a surprisingly active summer market. Year-over-year sales dipped slightly, sure, but month-over-month, sales were up for the third straight month. Seems like buyers who were waiting, election fears, trade war worries.
Yeah.
They're back in.
So engaging again.
Yeah.
Is it a hot market then?
Not exactly a frenzy. It's tightening, definitely under $2 million, but days on market. Still higher than we'd normally see.
Okay. Let's zone in on condos. This feels like maybe a looming perfect storm.
It's definitely a tale of two cities there.
How so?
Well, the good news, June saw more condo sales. That's helping clear out that huge amount of current inventory we've been talking about.
Right. Absorption is happening.
But the bad news, and this is the kicker for the long term, new construction starts for condos. They're down almost 90% from the 10-year average.
90%. Wait, have you seen anything like that recently? Is that normal fluctuation?
Not like this. This is drastic. It's setting us up for a major housing shortage down the road. And you know what that means?
Renewed price pressure. Big time.
Exactly. Which brings us to the human element. The art of the deal is getting harder. Buyers and sellers, they both seem to have this predetermined line in the sand. Less give and take, less collaboration.
Like poker game.
Kind of, yeah. Neither side wants to blink. Even though technically it leans towards a buyer's market, sellers are holding quite firm.
Interesting. Any other human trends?
Well, borrowers are definitely shopping around. Almost 30% switching lenders at renewal, especially here in Ontario and in BC, smart financial management. And foreign buyers, historically, Russia, China in the $3 million plus range now. We're seeing a noticeable increase from the Iranian community. Could really boost the luxury end.
Okay, so putting this all together, what's the path forward look like, say, for the fall?
I'd expect continued stability, slow, steady price gains, not huge jumps.
Wow.
That massive inventory, over 30,000 properties still listed, that acts as a natural cap on prices.
Right.
Makes sense. But connecting back to condos, yes, current absorption is healthy, good for sellers now, but that collapse in new construction, it's a ticking time bomb for future affordability and choice.
But for buyers right now, there's maybe an upside.
Definitely. Affordability has improved. We ran the numbers a typical condo bought in May 2025. The monthly payment is nearly $1,000 cheaper than buying the same place back in May 2023. Lower prices, slightly lower rates, making a difference.
Okay, so a real window there. This month really shifted things, didn't it? We went from frozen to active, but definitely tense.
Active but tense, yeah. With these emerging long-term risks, like that condo supply crunch.
So let's wrap this up. What does this mean for you listening?
Okay, quick takeaways. For buyers, you have negotiating power now, use it. But be aware that future condo supply is shrinking fast.
And for sellers?
Be ready for tougher talks. Price is absolutely key. But freehold fundamentals, still strong.
Investors?
That long-term condo supply crunch could be an opportunity later, but right now, focus on cash flow. Rents for smaller units have been softening a bit.
So the story for 2025. It's not just rates and sales anymore, is it?
Not at all. It's about that consumer strain we talked about, this looming supply crisis, especially in condos, and just a fundamental shift in how deals are actually getting done.
Lots to think about there. How will these powerful new trends play out? Something for all of us to keep watching.